All right, we are back. Our next guest is Marco Santarelli.
Hey Tom, how are you?
How's it going, sir?
I'm doing good.
You were on a trip?
Still am.
Oh, yeah? Where about?
It's a four-city trip over 2 weeks. So I went California to Arizona, Arizona to New York to Orlando, Orlando to Vegas, and then back to California.
Wow, is what's the cause?
The cause?
Yeah.
Projects, mostly real estate projects, but various things going on. A couple other investments going on in New York. So it's all
Awesome.
business. Yeah,
Fantastic. Great.
I'm
Well, hey,
tired.
look, it's always good to have you on. Sincerely, I recall way back in my 20s, I working a tech job, I was like the standard passive income. I gotta get out of this thing, right? And really couldn't make sense of the California investment model. So I found your podcast after listening to many, and I bought my first few turnkeys from Narada. Went great. It's almost like this addictive sort of process where you get one, you're like, oh man, I need like 10 more of these things. Um, and then as it is with real estate, the journey morphs into something else, and so it's really the genesis is a lot on your podcast and what you bring to the market. So one, thanks for that, but two, it's great to have you here to give that same sort of philosophy and just sort of your viewpoints on the market today to my audience. So thanks.
Appreciate it. No, it's great to be on here. So do you want me to just jump right into it?
Yeah, go ahead.
Okay, well, I'm going to share my screen here in a second.
Sure.
What I want to talk about today is why I'm bullish, have been, and still am bullish on real estate today going forward, and why you should be too. And I've had to kind of cut down a presentation a little bit here to fit a bunch of bullet points and some charts that I think your audience will find pretty interesting. But it just makes the case to show why investing in real estate is still and will be for a long time a strong investment. And I think there's a lot of people out there that are kind of sitting on the fence thinking, well, is it too late? Are we in a quote unquote bubble? What's going on? So hopefully I'll answer some of those questions here today as to why it does make sense and why you should
Yeah.
be still looking into real estate as an investment, as an inflation hedge.
Yep.
So let me share my screen here and I'll kind of run through it as quickly as I can. So let's see, I believe this was giving me a little trouble before, but let's see if it works. All right. All right. So why am I bullish on real estate today and why you should be too? So I don't know if your audience knows me at all, but I'll just take 2 seconds to talk about who I am. But really, I just consider myself a full-time real estate investor, even though I'm a serial entrepreneur. I'm a bit of an author and the founder of Norada Real Estate Investments. We're a nationwide provider of turnkey cash flowing investment properties. I started this business almost 18 years ago. So, and thanks to you and people like you, we're still in business and love what we do. But I started when I was 18 years old. I bought my first rental, and the writing was on the wall. I really ramped it up in 2003, buying 84 units in 9 months. So that was all 3,000 miles away from California to the eastern states, and I did it remotely. And I kind of perfected the system. So for those people who think that they can't invest out of state or do it successfully, that's not true. And your previous guest was also, great in playing into that whole thing about being an out-of-state real estate investor and being
Yeah.
successful at it. And last but not least, I'm host of the Passive Real Estate Investing podcast, which usually floats around the top 50 on the iTunes business list. And that's at passiverealestateinvesting.com. So let's jump right into it. Let's talk about some national trends, because this is fundamental to understanding why I'm bullish. You got to think about this in terms of economics 101. There's supply and demand dynamics that you need to take into consideration. So let's talk about the supply side first here. One of the things that happened a lot last year during COVID, but has been going on for a number of years, is baby boomers, who typically move every 6 years, have been staying put. In fact, now the average is 10 years. So the people who are actually moving to either move up or move down have been staying put. And because of that, there's less inventory that's being put on the market. And what that creates is what I'm talking about here, and it's a supply shock. So the inventory that we typically find coming out of baby boomers moving around or consolidating, downsizing, is not there. Another thing too, and this is a big one, is, and by the way, this has been going on for years, but
Yeah.
Freddie Mac has said that between 2020 and 2030, that we're going to have a housing unit shortage of somewhere between 900,000 to 4 million. Now that's a wide spread. The reason that is such a wide spread is because there are some dynamics in play that are showing that there will be some inventory to help ease that housing unit shortage. But the point is, and the problem is that we have a shortage today, we've had for many years, and it's not going away anytime soon. The
Yeah.
first sign
And
of relief is coming in 2024 with the amount of new home construction being built by home builders today.
yeah,
But regardless of whether it's 1 million or 4 million, that is a massive housing unit shortage in the years to come over the next decade. And that's going to create some pretty significant problems in terms of availability of housing, affordable housing, and just the push for people to, stay renters indefinitely. So we'll come back to that in a minute here.
yeah, and Marco, just one quick point. So I opened up the conference with me as a developer showing what I see for lots and all the supply and everything else. And today we see, from our estimates, it's a 3.8 million unit shortage. And if we're lucky, we'll close a gap of 800,000 units or so in the next 18 months. So
yeah, I mean, it's pretty tight. In fact, to your point, builders have been acquiring land, land buildable and paper lots like crazy. And we're talking a lot of major institutional investors who are spending billions of dollars on acquiring tens of thousands of lots that they will ultimately build on. So we have that shortage today. And this is why I said in 2024, 2025, we're going to start to see that ease, because there's going to be enough new construction coming along that it'll help to fill that gap. But it's still a shortage nonetheless. 4 years ago, we had 370,000 unit shortage. Right now, depending on what you're reading, the shortage is between 500 and 700,000 housing units in a year. So what does this mean? Well, it leads to increased occupancy. It leads to increased rental rates. It leads to increased property values. It's just, a simple function of economics. If you don't have the supply for the existing demand, it's going to create price inflation, and that's what's happening. So the bottom line here is supply is tight, and you got to keep that in mind. Now, again, I want to point out to everybody listening that I'm talking about real estate as from a national perspective. Real estate is local. It always has been. Everything that happens in real estate happens at a very local level. I'm talking in more general terms, just bigger picture, kind of the macroeconomic perspective today. We're not going to talk about specific markets, because obviously what happens in Detroit is different than what happens in, let's say, Houston, Texas, which is different than what happens in Cape Coral, Florida. So with that in mind, we're talking about broad strokes here. So let's look at demand fundamentals. So Fannie Mae now, has said for a number of years, and I've seen these numbers fluctuate from about 1.5 to 1.6 million, but we need about 1.62 million housing units per year to keep pace with population growth and just the organic growth and demand for household units. We're not achieving that. We're not meeting that, and that's the problem. But we have the demand out there, but we don't have the supply, as I was talking about a minute ago. And actually, we have not supplied the 1.62 million household units that we need since 2007. So think about that. That was 14 years ago. So we're constantly behind.
Well, and sorry, just real quick, on that note, the 2022 forecast is 1.28 million units to be built. And I think a lot of earnings reports now with Toll Brothers, Lennar, because of the supply constraints, that's going to come down from 1.2 to probably less than a million. So,
okay, well, we see a trend.
There we go.
Yeah, we see a trend. So, what is adding to the demand here? Well, first of all, we've got Gen Y, the millennials. They're now starting to move into the rental market. They started to move last year, but COVID kind of slowed things down. There wasn't inventory, so they stayed put either at home or in their existing rental units. But Gen Y is like the pig in the python. It's 72 million people in the U.S. It's a very, very large demographic. And it's just a matter of time before they're going to get out, start renting their own places, get married, have families, increase the household, the demand for households, and they'll want to move up. Gen Z, kind of a similar situation. The oldest is now about 23 years old. They're roughly, 70 to 80 million people in that demographic, and they're going to get out and start to rent as well. So they're going to be looking for apartments or, single family homes or part of a multi-unit property. So all these people are playing into this demand equation. And at the same time, affordability has become better and better because of historically low interest rates, and especially in the mid markets. Maybe not so much in the high end and the low end, because those don't really play in all that much into the bulk of people that are moving into the housing market. But affordability across the board has become increasingly better. So that's just driving more demand. So what's the bottom line there? Well, demand is strong. So what we have going on here is a tight supply, a strong demand dynamic across the country, pretty much in every single market. There's no market that has not seen the impact of this supply demand shock. And then we've got this coming shadow demand, which I'll talk about in a chart on the next slide or the next screen. But you can't see what is not visible to the eye, but there is a lot of demand that is in the shadows, in the background, that is coming to the foreground here, and that's just going to add more demand to this whole equation. And of course, the ongoing low interest rates, which are historically low, is just going to keep adding, to this demand pressure. And the thing is people don't buy necessarily based on price. If you really stop to think about it, when you buy a car or a house, you're buying based on monthly payments. Can I afford the monthly payment? It doesn't matter to you necessarily whether it's a $200 or $250 or $300,000 home, as long as the monthly payments are within what you can afford. So because of low interest rates, we're going to continue to see strong demand for housing. So the bottom line here is that home prices will continue to rise. Now, we're not going to see price appreciation like we did this year. It's an absolute anomaly what happened this year. Part of that is because of what played out from the C19 from last year. But the prediction over the next couple of years is we're going to see continued price appreciation, probably in a more normal range, in the 4 to 6% range, which is to be expected. So when we talk about pent up demand, this is an interesting chart. What this shows is the percent of young adults, those who are 18 to 29 years old, that are living with their parents in the US. And what you can see here is in this decade, we have the highest percentage of young adults, 18 to 29, living at home. This is only second to post-World War II in the 1940s. So what is interesting about this is there are a lot of people who are still at home living with their parents that will sooner than later need or want to get out of the house, rent their own place, buy their own place, or bunk up with other people just to get out. That's a lot of people. So the young adults are part of that shadow demand that is out there, and we know it's going to become a big problem, a good problem in a sense, because it's just going to help the housing market, but it's going to push demand up. So yeah, we've seen this trend here over the last probably 7 decades of increased young adults living at home, and that's going to come to a head here soon. Home builder confidence, which shows the sentiment between builders and home buyers, is near an all-time high. It's actually clocked in right now at about 83, 84. So this chart is a little bit dated, but it has continued. And really that just shows that there is demand for new construction, new homes to be built all over the country. That trend is continuing to the point where there is so much demand that a lot of new home builders have actually throttled back on how many sales they're releasing per week and per month. Yeah. So they have the lots, they are working on construction, they are building it out, but they're waiting to release new construction to new home buyers. And there's a lot of reasons for that. It's part of it's the supply chain being locked up without a lot of lumber and other materials coming through. But the other thing is that prices are appreciating so quickly that there is no point for them to release a sale or close on a sale prematurely when they know that they could bank on some extra points in profit by waiting an extra 3 or 6 months. Now, when we talk about these record high single family rental homes, what this chart is actually showing is the market value of all the single family rental homes over the last however many years, like 15 years plus, and is essentially doubled since 2010 from $2.2 trillion of single family rental home value to 4.4. Now, this is not really a function of supply or demand. It is indirectly, but what this is showing is that as an investment, if you have been investing in single family rental homes, as a whole, you can see that it has been a very consistent, predictable, strong investment class. And I argue that investment real estate is one of the best, if not the best investments you can make for many reasons. It's the tax benefits, it's the inflation hedge, it's the income, it's the appreciation that you get over time and the equity growth as an asset. But if you look back to 2005, you can see that it's held pretty strong, even though we've had various recessions. We had a great recession in 2008. C19 last year. It's been very predictable and consistent. Rental occupancy rates is an interesting thing to look at. We are back at our high point that we had back in 1995. So we've passed that with a 95.1% rental occupancy rate. That's great if you're a landlord, if you're a real estate investor, if you're looking to invest in real estate. This is a strong metric, because practically speaking, anything over 95% is considered full occupancy. I mean, you have your occasional turnover, but it's filled up quickly. So if you're in the 90s, especially over 95, you have virtually zero vacancy. So this is great. We're at a place where there is such a lack of inventory that units turn over very, very quickly. In fact, some of them turn over in a matter of days. It's just a matter of cleaning out the unit and moving in the new tenants. So this is a very exciting metric to look at. Now, when I borrowed this from John Burns Consulting, some of the data that I purchased from them, if you look across the country, at most of these major metropolitan areas, what you will see year over year for the last year up until July of this year, that the growth rate in the rents have been very, very strong. And I think anybody who owns real estate today has felt that, seen that, knows that. If you're renting yourself, you probably have felt it personally in your own pocketbook. But what we are seeing across the country is most all metropolitan markets have appreciated in terms of rent growth, somewhere between 5 and 10%. In fact, I personally, on a 22 unit property package that I have, bumped the rents up almost 10% across the board, in some cases even 15%. Wow. And there was no hiccup. We were still leasing them within days, if not within a couple of weeks. And there's no supply. That's the problem. So, like I said before, it's all pushing these rent rates up. Now, is that going to be consistent year after year for the foreseeable future? It's not going to be indefinite, but, we're going to still see strength for the next few years for sure, but probably not at the same rate or pace that we've seen. Some of the major markets to highlight here is Las Vegas, Riverside, California, Phoenix, and Atlanta, Georgia. Those four markets, for whatever reasons, specifically have seen greater than 10% year over year rent appreciation. So if you're a tenant there, obviously you're going to be feeling quite a pinch in your monthly budget towards your housing costs. But what we're seeing pretty consistently is 5 to 7% across the country in most markets in terms of price appreciation. What we're not seeing are markets where rent growth has been less than 1%. Pretty much every single market has seen rent growth. So, we're just in an environment right now where across the board, we're seeing property values increase, rents increase, mortgage rates stay consistently low. The credit to qualify has been strong. Average credit scores have been about 720 across the board. So borrowers are well qualified. It's not easy money or liar loans like we saw back in 2003 through 2006. So we have a very good environment and a strong, healthy environment. And we're not going to see a lot of foreclosures like a lot of people think, because of what has been going on with COVID and whatnot. These moratoriums, I don't think are going to impact anything, because demand is so strong that any supply that does come through the pipeline is going to be sucked up pretty quick.
Yep.
So I don't know how I'm doing on time. I'm going to keep
Well,
going here.
so again, you were not on when I was presenting, but it's amazing how similar our storylines are. And again, this was not planned, but a lot of this here and there are some of the same mantras that I was speaking about earlier. You're saying the same thing. So
Great. Yeah, that's fantastic. So, I like this chart because it reminds me of how great real estate is as an investment, because it is one of the best hedges against inflation. It pretty much works in lockstep with it. But what we're comparing here, I know it's a busy chart, but what we're let's start with the core CPI, the government's measure of inflation, which, if you believe it, so be it. But it's typically underreported. But the core CPI tends to fluctuate between, let's say, 2 to 4%, if you go back to 1985. The reality is they keep changing the metric. They keep changing the formula on how they calculate the inflation index. But the reality is that this is your worst case scenario. In most cases, real rates of inflation are higher. In fact, this year we've seen, especially with materials, building materials, and even food, that inflation rate has been as high as 15%. And a lot of you have probably experienced this just in looking at prices going up, in your daily life and in your own hometown. But regardless of what it is, if we just call it, let's just say, between 4 and 5% as the rate of inflation, rents have been keeping pace with that, in fact, exceeding it. If you look at this chart, the most recent data is that the core CPI is 4.5%. Rents have increased almost 6%. This has been consistent as an average around the entire country. Some markets have seen major double-digit rent price increases. Austin would be one of those markets. Atlanta would be another one of those markets. So we've seen strong rental growth. So this is just averaging out the major markets across the country. But the reality is a lot of markets have seen far more than 6% rates of appreciation in rents, especially with single family homes. Now, the nice thing about this, like I said, is this excites me, being a property owner with properties in different states around the country, that I know that my rent rate, the rent growth has exceeded the rate of inflation, which is what I wanted to do, because I want to meet or beat the rate of inflation. But the other thing here is it's not just your cash flow or your cash on cash return that comes from the rents. It's also the home price appreciation, which plays into the equity growth in your property. Now, we're showing 19.6. This year will probably close out at 20% or more as an average price growth across the country. But again, like I said before, this is not something to bank on. It's been an anomaly. The last 12 to 16 months have been an absolute anomaly. It's not anywhere near within the norm. But if you cut that out, you will see that property values have appreciated at least 6%, if not more, in most of the major markets for many, many years. So again, we're beating the rate of inflation. Now, this is due to two things. One is price inflation, and two is the liquidity in the market with, the stimulus and all the quantitative easing that's going on is creating liquidity and easy money and a lot of credit, which helps juice the markets. Like the stock market helps juice the real estate market, and that's playing into this as well. But let's not forget what I talked about in the first two slides. There is strong demand and short supply, and that's creating price inflation, which is going to continue for a while. So I shouldn't say you will, but you should continue to outpace the real rate of inflation for a number of years to come. So I can't predict the future, but the next 2-3 years are probably reasonably predictable. Okay, so I didn't want to get too deep into the weeds or too technical with this stuff. Bottom line with this slide is that real estate has been and continues to be a great hedge against inflation. And one of my last slides here, as I kind of wind it down, is just some tips for investors to kind of take this information and ask yourself, well, what do I do with it? So my tips for investors are basically this, and I'll just summarize these. I like to call this a top-down approach, but you pick markets with the lowest downside risk, which means that markets that are overpriced or inflated, especially in land value, like the coastal markets, and we're talking California, the northeast, new parts of New York, New Jersey, and whatnot. When land values are very high, especially when they exceed the improvement value of what's sitting on that land, that tends to give you higher downside risk, especially when we are in times of higher interest rates or in recession. So I tend to avoid those markets. Besides, it's easy to avoid those markets because the numbers don't typically make sense in those markets anyway. Your cash on cash returns are very, very low. Your cap rates are very low. Secondly, pick markets with positive migration trends. This drives that demand side of the equation. So as more people move in because of jobs and job growth, that migration tends to increase demand, push the housing market in a forward or upward direction, and it plays into price stability or increased prices, as what we've been seeing here for a number of years. Pick markets with a rational rent to price ratio. I'm not going to get too deep into this, but basically, the rent and price ratio have to be in line to where you're going to get a positive cap rate and cash on cash return with a reasonable rate of cash flow. In markets that I talked about with the higher downside risk or those that are very expensive, the property values are so high that the rents are just nowhere near what you need in order for it to be cash flow positive. And even if it is, your rates of return are so low. I'll give you a quick example. You're buying a single family home in many markets in California where you're paying $1 million for a single family home, which I wouldn't do. They only rent for about $3,500, $4,500, somewhere around there. So if you do the math, your rent to price ratio or rent to value ratio is about 0.4%, maybe 0.5%. That's not enough. I like to shoot for at least 0.8% and above. So that means if I'm buying a $100,000 home, I want it to rent for approximately $800 a month. Now, ideally $900 or $1,000, and they're still out there. They're becoming harder to find, but you want to get as close to 1% as you can. That I call that a little bit of the unicorn today, but it's there. And just winding this slide up, pick markets with available inventory. Obviously, some markets you're just going to beat your head on the wall, and take a top-down approach. Like I said, start with the market, do your research, find the markets that make the most sense from an investment perspective, then narrow down to the areas, then the neighborhoods. Neighborhoods are critically important when investing in real estate. Then start to look at properties along with your team that you build around you. And that's a subject for another day. So what's next? Here's where I wrap it up. Everything I talked about here today, well, not everything. Some of the things I talked about today, plus some other things, are in this 30-some page guide. It's a primer. I call it the ultimate guide to passive real estate investing. It's been downloaded probably 20, 30,000 times to date, maybe more, but it's a free download on our website at noradarealestate.com. And along with that, as Tom mentioned, I've got my podcast that I've been doing for almost 7 years now called Passive Real Estate Investing. And you can find that everywhere, including iTunes, or just go to passiverealestateinvesting.com for all the links. And that is pretty much it, Tom.
Yeah, no, again, all great content. I think it's good to hear it's consistently across all these experts that we have a similar story, and I swear we did not come together to create it. That's all individual. But yeah, I mean, again, Marco's podcast is a great way to get, sometimes very technical strategy, whether it be taxes or whatever it may be, and then sometimes it's conceptual as to how you really embrace that passive income mindset. So Marco, it's always great. Again, after this event, we'll do a blast out with all your content too. And one quick question from John P. Marco, I'm a big fan of the podcast. I'm good at reviewing comps, but how do you suggest how do you suggest basically finding the best comps for, I guess, rent and real estate potential?
Is the question for rental comps? Where do you find rental comps?
My guess is just generally probably owning a single family home. How best do you, what are some resources that they can use to, measure the potential of a property?
Well, are we talking like price or rent comps, or?
I'm guessing all the above. So market, rent.
Okay, well, So I'll just make assumptions on the question then. So if you're looking for numbers, if you want to do a quick, just a quick litmus test, websites like Zillow, whatever free websites are out there, you can get a snapshot. Now that's not going to give you necessarily an accurate number in terms of the market value or the rent, but it's just a starting point if you're just doing some high level preliminary research. At the end of the day, where you're going to get some real numbers is if you have a relationship there with two people. One is a real estate agent or broker, and two is one or more property management companies. There are tools out there, but all of them use predictive models or historic data to try and give you numbers, but the markets are changing so quickly that those are only frames of reference at this point. So with your agent and broker, you can get a pretty good idea of what the value, the market value is at any particular time, because they can pull sold comps very quickly off the MLS and just say, here are 3 or 5 recent sales within the last 3 or 6 months that are similar in square footage and bedrooms and baths to this property. It doesn't take them very long to do that. And if you have a relationship, they're happy to provide that. So that's how you can get, a quick idea of the market value, because appraisers are going to use that same data to do an appraisal. So you're going to be pretty darn close. And then with rental comps, if you have a relationship with one or more property managers, you can give them a call. Some of them are very busy, but you can give them a call and ask them, what would this property, bedroom, bath, and size in this neighborhood rent for? And they'll typically tell you, yeah, that'll be between 13 and 1400 or 13 and 1500. They'll give you a narrow range, and you can work off of that. But then just going to rental websites and just seeing what is for rent of the same square footage beds and baths will give you a pretty good idea of what other people, your competition, is asking. So when you look at what things are renting for in the open market, it'll quickly tell you what you can expect to get for a similar property.
Yep. And then last one here, we'll close this up for you. I know you're very busy. I get this one a lot too, and I'll give a quick answer, then maybe you chime in too. How do we find the best market to purchase in? Which is a really broad question, but I have formed my own long calculator, but some things that I look for, to your earlier point: population growth rates that are faster than the national average, median income growth rates that are faster than the national average, job growth, GDP growth, things that just indicate a diverse and strong economy. And with that, people moving there for the jobs and everything else. What else might you look at for a market viability?
Well, you hit all the big ones. I like to see a broad what's the word I'm looking for? In terms of its economic breakdown industry. I like to see diversity. The broader the industry, the better. I don't like one-trick pony markets that are based heavily on oil and gas, for example. If you've got finance, hospitality, construction, financial services, et cetera, that's good. Population growth is important, or at least stability. It doesn't have to be growing, but the stability. You want to see that there is a healthy dynamic between the inventory in that market, supply and demand. Look at the months of inventory within a market. If the months of inventory are low, like below 4 months worth of inventory, that's an appreciating market, and it might be tough to find inventory there. I like to be in markets that, and when we talk about markets, we could be talking about like metropolitan areas, or breaking it down and chunking it down into smaller suburbs. Like Atlanta is a massive area, like the Atlanta metro, but you got Stone Mountain and Decatur and all these other areas. I mean, you got to be a little bit more granular. But cities or suburbs of cities that are 100,000 plus in population are good. You don't want to be in micro markets, because there's just too many things that can affect and upset that apple cart, whether it's economic, interest rate wise, people moving in, moving out. One of the trends we're seeing today right now, and this will probably change, but what we've been seeing for a couple of years is people moving out of the core of cities into the suburbs. They get more square footage and more privacy and more yard for the same amount of money, if not less. And so, that's something to consider if you're actually looking at a market already, but you want to consider where within that market I should be looking at. So the suburbs have been very attractive and strong. You hit most of the major
Yeah.
ones, but and then just job and job growth trends. You don't need to know specific numbers like it's like 6.6%. Look at the trend over the last number of years. Look at where things are going. Are jobs growing, and are people moving into a market? That's a good sign.
Yep. Awesome. Yeah, that's great. Yeah, good stuff. Great questions. Marco, as always, it's always good to talk to you and touch base. Thanks for your time and enjoy your travels.
Thank you, Tom. Appreciate you.